Welcome back to the deep dive. There are some industries we interact with like every single day, yet we rarely give them a second thought. What if I told you there's a company in one of those fundamental, often overlooked sectors that actually calls itself a forever stock? Okay, let's unpack this. Today, we're taking a deep dive into the recent second quarter 2025 earnings call and the press release that went with it from WM, formerly Waste Management. Our mission is really to go beyond just the headlines and truly unpack WM's, well, what they call strong, consistent performance, their long-term vision, and figure out exactly why they feel so incredibly well positioned for the future. We're talking about this fascinating blend of their core business, which is, almost impossible to replicate with some really exciting new growth platforms they're building out. So to kick things off, let's look at the headline numbers for Q2 2025. Pretty impressive stuff. WM reported, get this, 19% operating EBITDA growth in the second quarter. And their total company adjusted operating EBITDA margin was almost 30%, 29.9% on an adjusted basis, to be exact.
That's, quickly approaching their historical best levels. They really lean into this concept of being a forever stock, driven by, well, a disciplined strategy, excellent execution, and some smart use of technology.
Yeah, and what's truly fascinating here, beyond just the sheer growth numbers, is how this performance isn't just some quarterly blip. The real insight, I think, is how WM really exemplifies the power of aligning a core indispensable service with these broader, unstoppable societal shifts, what they call secular trends. Think urbanization, population growth, increasing consumption, and yeah, the inevitable generation of more waste. It creates this kind of economic flywheel that honestly, few industries can genuinely replicate. It really proves why they see themselves as such a fundamental, enduring investment.
What I found most striking is that despite all the buzz around the new growth areas, sustainability, and all that, over half of that impressive operating EBITDA increase still came directly from their core collection and disposal business. How are they continuing to innovate and drive such strong performance on the surface? It seems like such a mature segment.
Well, it's a great question, and it really does highlight their operational excellence. Their core business isn't just like growing, it's becoming demonstrably more efficient and disciplined. For instance, their collection and disposal operating EBITDA improved a solid 60 basis points. That brings it up to 37.9%. And this wasn't just about, cutting corners or anything. Their core price remained healthy at 6.4%, and their collection and disposal yield actually improved sequentially to 4.1%. Volume was also up 1.6% in Q2 for collection and disposal.
Okay, 1.6% volume growth. What's behind that?
Well, there are a couple of notable things influencing that. Landfill volumes were particularly strong, partly thanks to robust MSW municipal solid waste volume growth. But there was also a significant boost from special waste volumes, largely related to the wildfire cleanup efforts in California. That was a big piece.
Right, I remember reading about that. But didn't they also lose a contract somewhere?
Ah, yes, good point. That 1.6% increase actually includes the negative effect of losing a relatively large franchise contract. It hit their residential and commercial volumes a bit, but WM, interestingly, views this as addition by subtraction.
Addition by subtraction.
Yeah.
That's a fascinating concept. What exactly does that mean for a company like WM? How does losing business help?
Exactly. It sounds counterintuitive, right? But essentially, that particular contract wasn't meeting their acceptable margin levels. So letting it go actually helps their overall profitability. It's not just shrewd business. It's really a testament to their ruthless discipline in prioritizing profitable growth over just chasing volume. That's critical if you want to be a forever stock. And this discipline extends to cost control, too. Q2 was actually a record period for them. Operating expenses were below 60% of revenue.
Wow, below 60%. Is that sustainable or just a one-off?
They'd argue it's sustainable. This isn't just temporary cuts. They talk about structurally lowering their cost base using technology and process discipline.
Okay, specific examples of that cost cutting. What kind of tech are they using?
Yeah, a great one is a 70 basis point improvement in repair and maintenance costs. Pretty significant. They're achieving this mainly thanks to their connected fleet and using real-time telematics. Basically, they can monitor their trucks, predict maintenance needs before they become big, expensive problems.
Smart. And it's not just machines, right? What about the people?
Absolutely. The human element is crucial. Driver and technician turnover, for instance, improved a really remarkable 370 basis points this quarter. It's down to 18.8%.
That's huge in that industry, isn't it? finding and keeping drivers.
Oh, absolutely. It's a massive win. They attribute it to modernizing the work environment, refining their coaching programs, things that make it a better place to work. And you also touched on acquisitions earlier. They completed the purchase of a regional solid waste player, I think it was, in the Washington, D.C. area.
Like the tuck-ins.
Exactly, the tuck-in opportunities. They have a really robust pipeline of those basically smaller strategic acquisitions that fit neatly into their existing network. They're expecting to spend more than $500 million on acquisitions this year.
So they're tightening up the core, making it more efficient, adding strategically. But it's not just about optimizing the old, is it? They're clearly looking to new horizons, too. Tell us about their big bets in sustainability and, more recently, healthcare. They've been investing strategically for decades, but really seem to be accelerating efforts now. It feels like that really widens their competitive moat.
Absolutely. And this raises an important question, How do these strategic moves beyond their core business not only add revenue, but also enhance their overall value proposition and their resilience? Let's start with sustainability. Their recycling and renewable energy segments delivered a pretty strong performance this quarter. The recycling segment, for example, saw 17% operating EBITDA growth.
Okay, 17% growth in recycling EBITDA. That sounds good.
It is good. But here's the kicker. They did that even as recycled commodity prices declined by nearly 15%. Prices dropped from about $96 per ton in Q2 last year to $82 per ton this Q2.
Wait, how does that work? Growing profits when the price of what you're selling falls that much? That seems counterintuitive.
That's the aha moment right there, isn't it? They attribute this growth in what's clearly a challenging price environment directly to their automation investments. By investing heavily in advanced sorting technology and automation at their facilities, they're able to process recyclables much more efficiently, slash their operating costs, and basically maintain profitability even when the market prices for the end commodities are down.
So technology is insulating them from market swings to some extent.
Exactly. Now, for renewable energy, they reported what they call margin-enhanced growth, and importantly, they've locked up 90% of their 2025 offtake volume.
Offtake. Remind us what that means. And they mentioned RIN prices, too.
Good question. So offtake just means they have long-term agreements already in place to sell 90% of the renewable natural gas they expect to produce next year. That gives them huge revenue predictability. And RIN's renewable identification numbers are credits used for compliance with renewable fuel standards. They locked in an average RIN price of $2.55 for that 2025 volume, which they noted is actually above current market rates. So a smart move there.
Locking in prices above market. Nice.
Yeah. And they've also already locked in 30% of their 2026 offtake at $26. So they're planning ahead. During the quarter, they also brought 3 new projects online: a renewable natural gas facility in Illinois, a recycling automation project in Pennsylvania, and a new market recycling facility out in Oregon.
So they're making tangible progress on those big sustainability goals.
Definitely. These bring their total completed RNG projects to 8 out of the 20 they have planned, and the recycling automation is now at 29 out of 39 planned facilities. It shows real execution on that long-term environmental solutions strategy.
Okay, then there's WM Healthcare Solutions, WMHS. That was this Stericycle acquisition, right?
Yeah.
What's the story there? How's the integration going?
Well, they've clearly positioned themselves to capitalize on the ongoing growth trends in healthcare waste and secure information destruction. And the integration seems to be well underway. They're already on track, they say, to achieve the upper end of their targeted synergies for this year. That's the $80 to $100 million range in 2025.
So the cost savings are coming through.
Seems like it. This has already led to a notable 190 basis point improvement in operating EBITDA margins for the WMHS segment since the acquisition closed. And their long-term synergy target is pretty ambitious: $300 million of operating EBITDA by 2027. That includes about $50 million they expect to get from cross-selling opportunities, selling WM services to Stericycle customers, and vice versa.
And are they seeing that cross-selling happen yet?
They are starting to. They mentioned they've already secured $11 million of annualized operating EBITDA from those cross-selling efforts. So early days, but moving in the right direction.
It sounds like a lot of positives, but they did mention challenges, did they? Something about interconnectivity of systems. Salesforce and SAP. That sounds like potentially a big headache during an integration.
Yeah, you definitely hit on a crucial point there. Integration on this scale is never without its bumps, right? And system interconnectivity issues, like getting Salesforce and SAP to talk to each other properly for things like customer onboarding, reporting, billing, routing those, can certainly be frustrating and cause delays.
Could those issues genuinely derail those ambitious synergy targets they've set out?
It's a fair question, but look, WM seems to be actively working on fixing them. The fact that they're transparent about these challenges while still saying they're on track for the upper end of this year's synergy target suggests they view them as manageable hurdles rather than, showstoppers. These are pretty common challenges in large, complex acquisitions. It's also worth noting something else they mention. The long-term capital intensity for WMHS is expected to be lower,
Lower capital intensity.
meaning it requires less ongoing capital investment relative to its earnings compared to WM's traditional trash business. They estimated around 8.5% for WMHS versus, say, 10% plus for the legacy WM business. That points to a potentially more capital-efficient growth path for this whole healthcare segment down the road.
Interesting. And what's the mix within WMHS?
Right now, the revenue is roughly 2/3 medical waste and 1/3 secure information destruction, like shredding documents. Their long-term aspirational growth target for the segment is around 5% to 6% annually, balanced between price increases and volume growth.
Okay, so putting it all together, strong core, growing new ventures, managing integration. What does this all mean for their overall financial strength and the path ahead? How healthy are they really looking?
Well, it's clear they're pretty adept at optimizing what they can control, right? Delivering on strategic priorities and, crucially, reducing their costs to serve. Through the first 6 months of 2025, WM generated $2.75 billion in operating cash flow. That's actually an increase of 9% year over year, which is impressive considering they had higher cash interest payments because of the debt taken on for the Stericycle acquisition.
Okay, strong cash flow. What about spending?
Yeah.
CapEx.
Capital expenditures totaled $1.56 billion in the first half. And as you mentioned earlier, they successfully pulled forward some truck deliveries, which actually helped their operating expense margins in the near term. All that resulted in free cash flow of $1.29 billion in the first half. And because of that strong performance and some other factors, they've actually upwardly revised their free cash flow guidance for the full year 2025.
Upwardly revised. By how much?
They're now guiding to between $2.8 billion and $2.9 billion for the year.
That's a significant jump in free cash flow guidance mid-year. What's the main thing driving that increase? Is it just the operational performance?
Operational performance is definitely part of it, but the key driver they cited is actually a recently enacted tax policy change. It restores bonus depreciation back to 100%.
Bonus depreciation. Okay, translate that for us.
Sure. For you listening, it basically means WM can deduct a much larger portion of the cost of new equipment they buy, like trucks or processing machinery, in the year they buy it, rather than spreading that deduction over many years. This significantly reduces their taxable income in the near term and boosts their cash flow. They estimate this policy change will add about $120 million to free cash flow in 2025 alone, ramping up to maybe $200 million annually by 2027.
Ah, okay. So nice tax tailwind helping them out there. What about capital allocation? Returning cash to shareholders.
Yep, they're doing that too. In the first half, they returned $669 million to shareholders through dividends. And on the growth side, they allocated $378 million to those solid waste tuck-in acquisitions we talked about. Their leverage ratio, so debt relative to earnings, was at 3.5 times at the end of the quarter. They project they'll get back down to their target leverage range sometime in 2026. So it shows a pretty disciplined approach to managing the balance sheet while still funding growth and acquisitions.
And the overall profit outlook for the year.
They're affirming the midpoint of their operating EBITDA guidance at $7.55 billion. So still expecting strong full-year profitability.
Now, here's a nuance I caught in the details. Their revenue outlook is actually about 1% below what they initially expected for the year. But at the same time, they're increasing their full-year expectations for operating EBITDA margin. How does that work? How can revenue be a bit lower, but expected profit margins be higher?
That's a great catch, and it really highlights their strong internal controls and that operational efficiency we've been discussing. The slight revenue headwind, as they explained it, is primarily due to two things. Those lower recycled commodity prices, which we talked about impacting the recycling segment revenue, and also some lingering effects from the harsh winter weather back in the first quarter, which suppressed volumes a bit early in the year. But this is the key part. Despite this revenue outlook being slightly softer, they are increasing their full-year operating EBITDA margin expectations by 40 basis points at the midpoint.
So they're squeezing more profit out of each dollar of revenue they do bring in.
Exactly. It really underscores their ability to manage costs effectively, find efficiencies, probably benefit from those automation investments, and maintain strong profitability even when facing some external revenue pressures. And just quickly on that, related to the healthcare segment, WMHS, they're also focused on SG&A selling, general, and administrative cost improvements there. The goal is to get those costs below 20% of WMHS revenue by the end of this year, and then drive that down further to around 17% by the end of their 3-year integration horizon.
Wow. Okay, so this deep dive, it really showcases a company that is, executing with discipline, isn't it? Leveraging its core strengths while also strategically building these future growth engines. You've heard about their strong financials, that incredibly resilient core collection and disposal business, and these promising new ventures in sustainability and healthcare that are really expanding their reach and relevance. It really makes you think about how essential and actually how strategic these seemingly, boring industries actually are.
It really does. And maybe a final thought to leave you with, building on that. Considering WM's stated goal of being a dependable community partner, and you see these significant investments they're making in both environmental solutions and healthcare solutions, how might their integrated approach to managing different kinds of waste streams, from household trash to recyclables to medical waste, how might that fundamentally change the way we as communities think about essential services and sustainability in the coming years? It's an interesting question to ponder.